Welcome back to the Afterburn series, the podcast where we go beyond the crisis to unpack the strategy, the setbacks, and the sharp pivots that follow. I'm Melissa, head of media and communications here at Taylor and Company, and today's topic is as bold as it is sobering. $1 billion gone. We've all seen the headlines, billion-dollar valuations evaporating overnight, massive bets that didn't pay off, and industries scrambling to find footing. But behind every dramatic loss is a story of decisions, signals missed or ignored, and sometimes structural change no one was ready for. To make sense of it all, I'm joined by my colleague Prashanth, Senior Partner for Global Strategy and Origination at Taylor and Company. Prashanth works at the front lines of global strategy, advising leadership teams on how to navigate uncertainty, recalibrate quickly, and most importantly, originate value in the aftermath of disruption. Today, we're digging into what $1 billion loss really means, not just on paper, but in leadership rooms, in strategy shifts, and in the long game. Prashanth, great to have you here. Let's dive in.
Thanks, Melissa. It's great to be here. When we talk about $1 billion gone, we're not just talking about numbers on a balance sheet. We're talking about confidence lost, strategy gaps exposed, and the ripple effects that can stretch across industries, geographies, and even entire business models. What I find most interesting and most important is that these kinds of losses often mark a turning point. They force leadership to confront not just what went wrong, but why it went wrong, and whether the organization has the resilience, agility, and clarity to recover and evolve. Sometimes it's about recognizing that the assumptions that drove a $1 billion bet were outdated before the ink even dried. Other times it's about execution, or a complete mismatch between ambition and capability. So, in this conversation, I hope we can dig into the anatomy of these losses, what they reveal, what they reshape, and how companies can use the aftermath not just to recover, but to rebuild stronger and smarter.
Let's bring this closer to home. We've seen billions in venture capital written off across India over the past few years, from tech unicorns that lost steam to aggressive valuations that couldn't be justified in post-pandemic market conditions. The write-offs haven't been subtle. Prashanth, from your vantage point, what went wrong? Were these failures of strategy, market misreading, or something deeper in the investment logic itself? And what does this mean for the future of VC in India?
That's a critical question, Melissa. And honestly, it's a mix of all three: strategy misfires, market misreads, and fundamental breakdowns in investment logic. The $1 billion write offs we're seeing in India aren't just isolated failures, they're systemic signals. These are not just the stories of a few companies losing steam, they are the outcomes of an era where ambition raced ahead of discipline and capital often chased growth without grounding it in operational maturity. During the funding boom of 2020 to 2022, capital was not only abundant, it was aggressive. Investors were under pressure to deploy quickly, often without the kind of rigorous commercial due diligence we associate with more mature markets. The underlying narrative was familiar: capture market share now, worry about profitability later. It worked in Silicon Valley, so why not here? But India isn't Silicon Valley, it's a price sensitive, infrastructure variable, and highly fragmented market. That nuance often got lost in the excitement. Startups across sectors like edtech, quick commerce, B2C fintech, health tech, and even D2C brands scaled prematurely, before their business models were validated at unit level, before customer behavior was fully understood, and before leadership teams had the experience or systems to manage hypergrowth. What's unique and troubling is how disconnected valuation momentum became from ground realities. A company might have had double digit month over month growth and still been bleeding money on every transaction. But in the euphoria of the moment, that was often seen as acceptable collateral damage for market leadership. Unit economics were overlooked. Product market fit was sometimes assumed, not tested. Governance structures were thin, often just a checkbox formality rather than a true mechanism for accountability. Board oversight became diluted as investors prioritized speed and optics over scrutiny. And many founders, visionary as they were, simply hadn't faced downturn cycles before. Hypergrowth masked operational debt, and when the capital tide went out, the vulnerabilities were exposed. But I want to be clear, this isn't a story of doom, it's a reset, a much needed one. We're now witnessing a shift from valuation-led narratives to fundamentals-first growth. Investors are asking tougher questions. Founders are focusing more on sustainable models. The idea that profitability is an afterthought is quickly losing favor. There's a greater emphasis on disciplined capital deployment, clearer revenue pathways, and risk-adjusted execution. Startups are being built with more intention and more humility. Even governance is evolving. We're seeing greater appetite for independent board members, real-time reporting tools, and strategic advisory at earlier stages. Many VCs are taking a more hands-on role, helping founders navigate not just funding rounds, but operating challenges, talent development, and crisis planning. So yes, over $1 billion has been written off. And yes, some of those losses were avoidable. But those losses are teaching us something invaluable: that scale without structure is fragile, and that hype without discipline is a liability, not an asset. If we listen closely, these write-offs are telling us where the cracks were: in judgment, in diligence, in execution. And more importantly, they're giving us the blueprint for building better, more resilient ventures moving forward. Because ultimately, failure isn't the enemy, complacency is. And if we use this moment to recalibrate, India's startup ecosystem can emerge leaner, wiser, and far more capable of building businesses that last. So while $1 billion may be gone, the value of the lessons it leaves behind could be worth far more, if we're willing to act on them.
Prashanth, this has been a deeply insightful conversation, one that cuts through the noise and gets to the real story behind the numbers. Before we wrap, I want to bring it back to the heart of the matter. For founders listening today, maybe they're early in their journey, or perhaps they're navigating uncertainty right now. What's the one principle or mindset shift you'd urge them to adopt in this post-boom, post-write-off reality? In other words, if we're closing the chapter on scale at all costs, what does the next chapter need to be titled?
That's a great way to close, Melissa. And honestly, it's a question I've been reflecting on with many of the founders and leadership teams we work with. If the last chapter was titled Scale at All Costs, I think the next one should be called Earn the Right to Grow, because growth isn't something that should be assumed. It's something that has to be earned through clarity, discipline, and staying deeply connected to the market you're serving. The mindset shift is this: growth isn't the strategy, it's the outcome of a strategy that works. For founders today, that means asking harder questions earlier. Not just how big can this get, but how does this survive pressure? What makes this sticky? Is this solving a real problem at a price someone is actually willing to pay again and again? It also means treating capital as a resource, not a solution. The goal isn't to raise more, it's to use what you have with precision. Great companies aren't built on burn rates. They're built on knowing what truly moves the needle and saying no to everything else. And finally, I'd say this: resilience matters more than ever. The path ahead will be harder, but also clearer. The market is demanding substance, not just stories. But for those who build deliberately, who align product operations and purpose, there's an enormous opportunity to lead the next, more sustainable wave of innovation in India. So yes, $1 billion may be gone, but what's ahead can be built on stronger foundations, and those foundations start with a shift in mindset, from entitlement to endurance, from hype to habit, from momentum to meaning. That's the chapter we're in now, and I think it's a better one.
Powerful words, Prashanth. And the perfect note to end on. What we've unpacked today goes far beyond venture capital or valuation math. It's about a mindset shift, one that's not just overdue, but necessary. The write-offs may dominate the headlines, but the real story is what comes after: the reflection, the reset, and the rebuilding. To everyone listening, founders, investors, operators, thank you for joining us for this episode of the Afterburn series. We hope this conversation has given you not just insight, but perspective. If you found value in what you heard today, share it, start a dialogue, challenge the assumptions around you, because that's how ecosystems evolve, not in silence, but through shared learning. I'm Melissa, Head of Media and Communications at Taylor & Company. And we'll be back soon with more voices, more stories, and more lessons from the edge. Until next time, stay sharp, stay grounded, and keep building what matters.